Right, this is the euro having moved on down, and it moved down in a series of three waves, and Elliott wave watchers will recognise an ABC pattern where C came down to be a measured move, measured at the same vertical distance as the distance travelled by A. Now the important thing down here is that eventually price came to a bottom. How do I know it's a bottom? Because price has not subsequently gone any lower. So we've got a pivot. Price then sort of popped up, pivot back down again, and then it formed a very, very strong engulfing. So yeah, there may well have been traders who would get in at that point, and it would have been perfectly valid to do just that. But subsequently price did come down a little bit lower, but at no time did it actually break the preceding low. And it did so when it did go to a new low. It did so with one of these bullish engulfing candles. Now, what you can actually pick out here are a whole series of points. So, without a doubt, this has dropped into a consolidation range, but at no time did it go to a new low. So that just characterizes a consolidation range, bounded between a low and a high, but within it's got bullish candles. Now let's just look at getting some trades on here. This is a true multi-point reversal in that we've got point 1, point 2, point 3, point 4, point 5, point 6, point 7, point 8, point 9. So there are 9 pivots within this, and this is bounded within this trading range, and then price starts to move higher. Now, one of the key things is with identifying these reversals is to spot where the low is, spot the higher low, followed by another higher low, which is in turn followed by a higher high. So the trend is now moving to an uptrend, and then finding the entry point with relatively narrow range candles. Now, simple reason that I like narrow range candles, it means that I can get the trade in as price subsequently moves above a narrow range candle, and I can get a trade on with a relatively tight stop. Now, this just happened to be a daily chart, so each one of these candles is one complete day, and as you can see, the number of pips is quite considerable, so one will clearly be adjusting position size to cope with whatever the stop loss would need to be. So, where would you enter? Got a narrow range candle there, followed by an engulfing. So we've got an engulfing, narrow range candle, which is Hallmey, and then we've got the breakout candle from there. That is the candle to gauge your entry on. Okay. Now, those traders who want further confirmation that this has genuinely moved out of the trading range, then another opportunity comes there at 2. And at 2, we've got yet another narrow range candle. It's an Hallmey, and then the breakout beyond there. Where would a trader want to put a stop? Well, just below the narrow range Hallmey candle. So you're quite right. Just going back there, Jez, that yeah, we've had this move on up, and in fact, one may well, on the basis of this candle completely engulfing the preceding candle, one may well have gone long there. Well, absolutely, yeah, why not? You go on long, but then of course it does reverse on back down, comes back into the trading range, and of course that's the preceding shooting star there. So one may well have gone long at 0.7 there, and of course money management would have ensured that the trader would have been protected, and then of course price came on down. Now if the trader still had a piece of that trade on, as money management would suggest that he or she should, then when we start to get this further consolidation here at 0.1, one could add into it, and then from here price, up it goes, up to point 2, and there's yet another opportunity to add further into this position. So this sort of pattern is one that does lend itself to scaling in to build up a position. But at the same time, as momentum dies, partial profits can be taken. And in a subsequent session, then I'll be going into money management in somewhat more detail.